China's economy is unraveling at breakneck speed. Real estate empires are collapsing, foreign investors are bolting, and Beijing's rescue attempts are falling flat. But in the middle of this storm, one story has eclipsed all others. Hong Kong tycoon Li Ka-shing, China's richest and most influential entrepreneur, is now under direct fire from the Chinese Communist Party. Back in March, Li announced a $22.8 billion deal to sell 43 port assets in 23 countries, including 90% control of the Panama Canal's Balboa and Cristobal ports, to BlackRock. 5 months later, the deal is frozen as Beijing blocks and reviews it. The message couldn't be clearer. In Xi Jinping's China, no fortune is safe, no matter how big or how global. And this clash isn't just about one man. From the Panama Canal to Hong Kong mansions, from foreign capital flight to escalating US-China tensions, Li Ka-shing's showdown with the CCP lays bare the fragility of China's system. The bigger question: by attacking its own tycoon, is the party accelerating its own collapse? All of this will be covered in today's episode of China Unfiltered. Before we dive into all of this, let us know in the comments where you're watching this video from. Connecting with viewers across the world is a huge source of inspiration for us. The 3 consequences that could shake China. Li Ka-shing versus the CCP. This dramatic clash didn't appear out of nowhere. It began in early March, when Li Ka-shing's CK Hutchison Holdings unveiled its plan to sell, triggering a chain reaction from Beijing, from state-run media attacks to direct intervention by regulators. On March 4th, Li Ka-shing's conglomerate CK Hutchison Holdings announced a blockbuster plan to sell its portfolio of 43 port assets in 23 countries worldwide for $22.8 billion to a consortium led by the American asset management giant BlackRock. Among those assets are 90% of the equity and operational control of 2 strategic facilities, the Balboa and Cristobal ports, at both ends of the Panama Canal. But this move by Li Ka-shing triggered an immediate and furious backlash from Beijing. Between March 13th and March 21st, the CCP-controlled Hong Kong newspaper Ta Kung Pao published 4 scathing commentaries. They accused Li Ka-shing of betraying and selling out the Chinese people. On March 18th, Bloomberg reported that Beijing had instructed the State Administration for Market Regulation and the Ministry of Commerce to launch an official review, examining whether the deal posed national security risks or violated antitrust laws. Just 1 day later, on March 19th, the Wall Street Journal revealed that Xi Jinping himself was outraged. According to sources, Xi was furious that Li Ka-shing had acted first and informed Beijing later. The real concern? By selling the Panama Canal ports, Beijing lost an important bargaining chip that Xi had planned to use in future negotiations with US President Donald Trump. On March 27th, Bloomberg further reported that CCP authorities had ordered mainland state-owned enterprises to suspend any new cooperation with businesses tied to Li Ka-shing and his family. Then, on March 28th, the South China Morning Post cited insiders saying that CK Hutchison would not be signing the agreement to sell the Panama Canal port operations on April 2nd as scheduled. On the same day, the CCP's market regulator formally announced that the deal would be subject to review. So how should we view the CCP's suppression of Li Ka-shing? Analysts point to 3 major consequences. First, direct confrontation with the United States. From the moment he took office on January 20th, President Trump declared that the CCP was controlling the Panama Canal. He insisted the United States must take it back, if necessary, even with military force. Why such determination? Because the Panama Canal is one of the world's most strategic waterways, linking the Pacific and Atlantic Oceans. Built by the U.S. between 1904 and 1914, it came at a staggering cost, financially and in human lives, with 38,000 American workers dying during construction. The United States handed over control of the canal to Panama in 1999, after a 1977 treaty ensured permanent neutrality. Yet the canal remains critical to America's economy and national security. Over 70% of its traffic involves U.S. trade, making it indispensable for the rapid deployment of both commercial and military vessels. Back in 1997, Li Ka-shing's company secured concessions to operate ports at both ends of the canal, renewing that deal for another 25 years in 2021. In 2017, Panama cut ties with Taiwan and recognized Beijing, opening the door for more than 40 Chinese companies to move into Panama across infrastructure, shipping, finance, telecom, and logistics. So when Trump warned that Beijing was tightening its grip on the canal, many brushed it off. But the CCP's aggressive response to Li Ka-shing's deal has validated Trump's warning. Let's be clear. Li Ka-shing is a private entrepreneur. His company CK Hutchison is registered in the Cayman Islands, not Hong Kong or mainland China. His nationality is Canadian. And the sale of the Panama ports to BlackRock had nothing to do with the CCP financially. Yet simply because he resides in Hong Kong and still has some businesses in China, the CCP demanded that Li Ka-shing align his personal or family business with party interests. For a foreign-owned enterprise controlled by a foreign national, this level of interference amounts to outright coercion, bullying, and intimidation. And if war between the US and China ever breaks out, Beijing could pressure Li Ka-shing to shut down these ports, posing a direct threat to America's economy and security. In short, the crackdown on Li Ka-shing highlights exactly what Trump has been saying. The CCP's control of the Panama Canal is real, and it is a threat. Second, frightening China's private entrepreneurs. China's private sector once thrived under reform and opening up, celebrated for its 56.789 contribution, over 50% of tax revenue, 60% of GDP, 70% of innovation, 80% of urban employment, and 90% of market entities. But since the 19th Party Congress in 2017, the CCP has doubled down on the idea that the party leads everything. State-owned enterprises have advanced, while private firms have retreated. Party power increasingly dictates resource allocation. The impact has been devastating. In 2020, the Three Red Lines policy strangled real estate firms, sinking giants like Evergrande and Country Garden. In October 2020, Jack Ma criticized financial regulators, and Ant Group's $34 billion IPO collapsed overnight. By April 2021, Alibaba was hit with an 18.2 billion yuan fine. In July 2021, Didi was ordered off app stores, then forced to delist from the NYSE a year later, wiping out 380 billion yuan in value. Sudden crackdowns on tech and education in 2021 wiped out trillions of dollars in market capitalization. Entrepreneurs like Sun Dawu saw assets seized and themselves jailed. By 2023, China's stock, currency, housing, and bond markets all slumped together. In 2024, Beijing rolled out stimulus after stimulus with little effect. And in early 2025, Xi Jinping personally courted private entrepreneurs, insisting he had always supported them. Yet almost simultaneously, Beijing struck down on Li Ka-shing. The message is unmistakable. In China, major deals must be approved by the party. Obey, and you may survive. Defy, and you will be punished. It's no surprise, then, that Li Ka-shing has steadily withdrawn from China under Xi's rule. Today, more than 80% of his income comes from overseas, in the UK, Canada, and Australia. And the CCP's crackdown will only accelerate the exodus of private entrepreneurs seeking to escape. Third, speeding up foreign capital flight. Li Ka-shing's chosen buyer was BlackRock, a firm once seen as Beijing's old friend. BlackRock is a top foreign shareholder in Tencent, Alibaba, China Construction Bank, Ping An Insurance, Xiaomi, NetEase, Shanghai Real Estate, and Meituan. But China's worsening business climate has changed the calculus. In early 2024, BlackRock tried to sell a Shanghai office building at a 30% discount. Later that year, its Asia-Pacific chief said China was no longer part of the company's investment plans, pointing instead to Australia, Japan, and Singapore. The broader trend is clear. Foreign capital is leaving. In 2024, net outflows reached $168 billion, while inbound investment sank to just $4.5 billion, the lowest since 1992. Even as Xi Jinping told foreign executives in March 2025 that China is an ideal, safe, and promising investment destination, regulators were busy reviewing and potentially blocking Li Ka-shing's deal with BlackRock. By intervening so brazenly, the CCP is sending one message to global investors: get out while you can. $5 billion Hong Kong dollar mansion sale. Did Li Ka-shing try to leave Hong Kong? While the Panama Canal deal remains in limbo, new rumors have swirled around Li Ka-shing himself. In recent months, Social media and viral videos claimed that Hong Kong's richest tycoon was preparing to sell his famed feng shui mansion at 79 Deepwater Bay for 5 billion Hong Kong dollars, and even planning to leave the city. They also alleged that just 2 months earlier, he had offloaded mainland assets at a steep 40% discount, cashing out to invest in the United Kingdom. According to the South China Morning Post, Li's family has firmly rejected these claims. His son, Victor Li, chairman of CK Asset, issued a rare public statement, calling the reports entirely fabricated, speculative, and lacking any factual basis. The family stressed that the mansion, purchased by Li's late wife in 1963 for only $650,000, has never been put up for sale. But according to China Observer, senior expert Mr. Z suggests otherwise. Victor Li's public denial should be seen as a strategic move within the Li family, because Li Ka-shing himself has not spoken. This silence is telling. The rumored price of 5 billion Hong Kong dollars is in line with market expectations, and even at the age of 97, Li remains the sharp and undisputed head of the family. For him, the sum is trivial. What matters is symbolism. 79 Deepwater Bay is not merely property, it represents the Li's choice of survival and business environment. Refusing to sell sends a powerful message. Li intends to cut ties not only with Hong Kong, but with the Chinese Communist Party itself. His private move comes at a time when Hong Kong is unraveling. In just 3 years, over 480,000 residents have fled. Pro-democracy elites in exile even launched a self-styled Hong Kong parliament abroad, prompting Beijing's loyalist government to issue arrest warrants and bounties for 19 of its members. The backlash was immediate. The US, UK, and other allies condemned Hong Kong's actions. Secretary of State Marco Rubio warned Washington would not tolerate the use of national security laws to intimidate Americans, calling it transnational repression that violated the promises made in the 1997 handover. London went further, terminating its extradition treaty with Hong Kong altogether. These events underscore what many feared. Hong Kong's government has fully degraded into a CCP-controlled regime, relying on fear and coercion to maintain order. Meanwhile, the exiled parliament is preparing for the day the CCP collapses, ready to restore Hong Kong's autonomy and calm a city stripped of hope. And through it all, one man's story casts a long shadow. Li Ka-shing, Hong Kong's most famous tycoon, has always acted with an uncanny sense of timing. First to invest in China in the 1980s, and first to pull out decades later. But perhaps his greatest warning came not from a boardroom decision, but from a moment of terror in 1996. That year, his son Richard Li was kidnapped by Chung Tse-kyung, Hong Kong's most feared gangster, known as Big Spender. After paying a record ransom of about 1 billion Hong Kong dollars, Li reflected with chilling honesty. It was his fault for believing he could live in Hong Kong without constant vigilance. That bitter lesson, born of fear and foresight, now feels like prophecy. Long before the handover was complete, Li Ka-shing had already foreseen what Hong Kong would become under CCP rule. CCP accelerating its own downfall. The suppression of Li Ka-shing, the freezing of his Panama Canal deal, and even the rumors about his mansion all point to the same conclusion. Under Xi Jinping, the party decides everything. Mao's doctrine that the party leads everything once brought China's economy to collapse. Deng Xiaoping loosened that grip and unleashed growth. But Xi has returned to the same path, transforming a market economy into a power economy, where politics overrides markets and loyalty outweighs law. History shows where that road leads. It ended communist regimes in the Soviet Union and across Eastern Europe. And by repeating those mistakes, suppressing Li Ka-shing, confronting the United States, frightening entrepreneurs, and driving out foreign investors, the CCP may only be accelerating its own downfall. That's all for today's episode. If you found this story insightful, share your thoughts in the comment section, and let us know what you think about the topic. Don't forget to like and subscribe so you don't miss any future episodes. Thanks for staying tuned. We'll see you next time.